It was past 10 at night when Scott Sullivan found her. Cynthia Cooper had been working late on purpose, running database queries after hours, in the dark, so her own CFO wouldn't see what she was looking for. He found her anyway. He told her to stop the audit. She said no. What she had already found was $3.8 billion in fraud. What she didn't know yet was that the number was going to more than triple. Before we get to Cynthia Cooper, I want you to meet someone you've never heard of. Her name is Vinson. She was a senior accounting manager at WorldCom. She had spent years building a career at one of the fastest-growing telecom companies in the world. She was not a fraudster. She knew what was being asked of her was wrong. We know this because she wrote a resignation letter saying exactly that. She never submitted it. She shredded it, went back to her desk, and made the false entries anyway. Vinson was sentenced to 5 months in federal prison. Her career was over. Her name is now a case study in every accounting ethics course in the country, not as a villain, but as a warning. The man who ordered her to make those entries served less than 2 years. That's the story of WorldCom, and we need to understand exactly how it happened. Here is what I want you to take away from this video before we go any further. The WorldCom fraud was not a rogue CFO acting alone. It was a machine, and the machine worked because it found the people in the middle, the Vinsons, and made the cost of saying no feel higher than the cost of going along. That's not a WorldCom problem. That's a human problem, and it's why this keeps happening. Bernie Ebbers was not supposed to be a CEO. He was a former basketball coach and milkman from Mississippi who stumbled into the telecom industry in the 1980s and turned a small long-distance company called LDDS into an acquisitions machine. By 1997, he had renamed it WorldCom, swallowed MCI in a $65 billion deal, the largest merger in U.S. history at that point, and made himself one of the most celebrated CEOs in America. Wall Street loved him. The press called him the telecom cowboy. His shareholders made fortunes. He also borrowed $400 million from his own company, using his WorldCom stock as collateral. He didn't disclose it. When the stock started falling, the margin calls came, and Bernie Ebbers needed WorldCom's stock price to stay up. So he told his CFO to make the numbers work. Scott Sullivan was everything Ebbers wasn't. Harvard-educated, technically brilliant. CFO magazine had named him CFO of the Year. He understood exactly what Ebbers was asking him to do, and he understood exactly how to do it. The mechanism was almost elegant in how simple it was. WorldCom paid billions every year in what were called line costs, fees to use other companies' phone networks. These were operating expenses. You deduct them from revenue. They reduce your profit. Sullivan started moving them to the balance sheet instead, classifying them as capital expenditures, long-term assets. On paper, costs disappeared, profits appeared, earnings targets were hit, the stock held. They did this for 7 consecutive quarters, $3.8 billion in false entries, $11 billion total when the full picture emerged. And then Cynthia Cooper started asking questions. Cooper ran WorldCom's internal audit team. In early 2002, one of her auditors, Gene Morse, flagged something strange. $500 million in computer expenses that had no documentation and didn't match any capital project she could find. She could have escalated to Sullivan. Sullivan was her boss's boss. She went around him instead, directly to the audit committee chairman. Sullivan found out. He tracked her down outside the office and told her to delay the investigation by 1 quarter. His reason: the timing was bad. She refused. Her team started working nights, not because they were asked to, because Cooper didn't want Sullivan to see the queries running during business hours. They were inside the books of their own employer, building a fraud case in secret after dark. On June 20, 2002, Cooper reported her findings to the board. Sullivan was fired 5 days later. On June 26, the SEC filed civil fraud charges against WorldCom. On July 21, 21 days after Cooper went to the board, WorldCom filed for Chapter 11 bankruptcy. It was the largest corporate bankruptcy in American history. 30,000 people lost their jobs, pension funds wiped, shareholders lost billions. Scott Sullivan told Vinson the entries were legal. He told her she was overthinking it. He told her to trust him. She wrote a resignation letter. She shredded it. She trusted him. Sullivan served less than 2 years. Vinson served 5 months in federal prison and spent the rest of her career explaining a felony conviction to every employer she applied to. He gave the order. She followed it. She paid more. Here's what the WorldCom story actually teaches us, and it's not what gets taught in business school. The fraud didn't survive because Bernie Ebbers was a genius. It survived because the system around him was full of people like Vinson. Competent, honest people who calculated that the cost of saying no to their boss, to their mortgage, to their career, was higher than the cost of going along. That calculation gets made in every major fraud. It's being made right now somewhere by someone sitting at a desk writing a journal entry they know is wrong. The question is never really how did the CEO get away with it. The question is always, what did we build that made the people around him too afraid to stop him? Cynthia Cooper stopped him. She was the exception. She was named Time Person of the Year. Vinson tried to stop him. She wrote the letter, then she shredded it. She got 5 months in federal prison. The difference between them was one decision, one piece of paper that didn't get sent. Bernie Ebbers stood in court in 2005 and said he didn't understand the accounting. The man who built a $65 billion company said he didn't know what was on his own balance sheet. The jury didn't believe him either. 25 years. He was released in 2020 on compassionate grounds. He died 4 months later. 30,000 people never got their jobs back. Follow for more stories about the people who broke the system and what it cost everyone who worked for them. Next up, the man who discovered Madoff's fraud in 2000, 2 years before anyone listened. He sent the SEC a 19-page proof. They filed it away. We found it.